You're about to join Jerry Parker, Moritz Seibert, and Niels Kaastrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker and I, Niels Kaastrup-Larsen, are back with this week's edition of the Systematic Investor Series, where each week we give you a raw and honest account of what it's like to be a rules-based investor, what news and articles caught our attention, and of course, we also attempt to answer all of your questions. Moritz is out this week, so you just have the two of us. So good morning to you, Jerry. How are you doing?
Good morning, Niels. How are you?
I'm doing very well. I'm doing very well in a wet and rainy Switzerland today, but other than that, I'm doing fine. Now, it was a week with some healthy moves in many of the markets. I thought when I was looking through kind of my usual list of about 50 markets, I noticed quite a few of them had, 4 or 5% moves this week, which is not bad for a single week. On the upside, we had a lot of solid moves in grains and soft, which enjoyed another week of counter-trend rallies, as far as I can tell. And on the downside, it really was dominated by all things energy this week. But also, if we scale down and just look at markets that lost 1 or 2%, we had quite a few equity markets, still trying to make sense, I guess, of this trade tension. So a little bit of movement. And, since Moritz is out, let me just continue and see where, how that all played out on our side from a trend-following portfolio perspective. Clearly the dominant factor in the portfolio, the overall, I would say the returns were mildly down, so not a big move in the weekly returns on our side, but it was certainly divided into a couple of camps. Clearly, grains and soft lost a fair bit of money during the week. Our short positions, we've maintained but reduced, but they're the ones hurting in a week like that. Currencies as well. I think the dollar softened up against some of the currencies, so that didn't help either. But then, and I would say it just sort of continue on the downside. Equities, not great either. Even though it was kind of mixed, since we do have both short and long positions in the equity sector. But to counter all of this negativity, we really had some solid performance from fixed income, continues to march lower in terms of yields, higher in terms of price, and then energy. The big moves down on Thursday, in our case at least, helped since we've maintained short positions in many of those energy markets. So kind of a mixed bag, but overall slightly down. Still up for the months, up for the year, of course, but a little bit unusual simply from it's been a while since I've seen so many markets starting to move with that intensity, really, which I think from a CTA or trend following perspective is probably not a bad thing. There might be some transitions, some changes in positions that may hurt initially, depending on time frames and so on and so forth. But it certainly feels like there's a bit more energy, pardon the pun, but energy in the moves right now. So I don't know what it looked like on your side, Jerry, and certainly maybe also the individual stocks had some interesting moves this week.
Yeah, you're always able to find something going on there that's interesting. Once again, my whole focus is just having a very diversified group of stocks and, everything, commodities, currencies, fixed income. So I did have a stock rally, a short rally this week in the face of a lot of selling. So that was kind of interesting. I guess I have some diversification, but I did lose money on that trade. So it's kind of funny to watch that. Corn is a big mover. I got some fundamental information, which I try to stay away from, of course, Wednesday or so about corn going up, and I noticed that, well, it's kind of unchanged today, but then it had big rallies. And so I think that's probably going to be a long coming on Tuesday or so. But yeah, it's some violent moves, and the stocks are kind of it's uncomfortable to sit there and watch them be down 400 or 500. But yeah, it's hard to say. I feel a little vulnerable on the dollar. We've big profits in some of those shorts, and they're probably going to a lot of open profit there.
Yeah, it certainly feels like one of those periods where you can see a little bit of also volatility, so to speak, in our own returns, just given the fact that we've had some decent trends really in the first few months of the year, and so as you say, there is a lot of open profit around, but then that's obviously the job and the discipline that we add to the table, so to speak, as trend followers. That even though we may have our opinions, it doesn't really change how we implement our trades. Yeah, cool. Let me, before we jump into your favorite tweets for the week, let me give you a quick update on the live event we've been teasing for a couple of weeks here on the show. We very much appreciate all the interest we've seen. And if everybody showed up that has expressed an interest, we would be full. So that's amazing. Appreciate that. Let me give some more details on what we're planning. So we've decided on the dates for the event. It'll be October 26th and 27th, which is a Saturday and Sunday. So hopefully that means more people can come. It's outside of work hours. It will be in New York, as previously mentioned. And the format of the live event is the aim of it is really to try and create some real breakthroughs for this small group of people. So we're planning only to have 12 people, present with Moritz and Jerry and I in New York, and it'll be kind of what I can broadly describe as a kind of a mastermind format where we are there to help you create some breakthroughs in your businesses or in your trading. So whether it be model/systems questions, whether it be business questions of how to grow your business, how to start your business, or whether it be how to raise assets in an environment like this. I mean, between the three of us, we've all done it. We've all done it for a long time, and hopefully we want to pass on that experience and so on and so forth to the people showing up. And I know also that there will probably be some well-established managers. I know certainly one in the short-term space will be there. So there's going to be a lot of interesting people there, and also it's for everyone to kind of help create those breakthroughs. So I think it'll be super cool, very interesting. And for those of you who have not yet reached out to us, and we will prioritize those who come first for sure. But send us an email to info@toptradersunplugged.com. Put live event in the subject line, then that's easy for us to see, and then I will give you the final details of the event. But we hope to and if it's something that people like, maybe we'll do it another time and in another location as well. So enough about that. We're going to go back to our usual format, and we're going to find out from Jerry a little bit about what caught people's attention in terms of tweets and articles. So what did you see on your side this week, Jerry?
Well, I think the most interesting thing to me was maybe just one topic from the tweets this week. We could just try to beat this one to death about equity returns, and are they should we expect them to continue? Which I think the whole world is like, yes, you should. This is what the whole industry is built on, except you weird CTAs, is equity returns, analyzing and assuming they're going to continue like the past. I'm pretty sure that the drawdowns will continue. But I don't really think that there's enough evidence for me, not the way that I put together my trading and portfolio and the way that we do it. I can't say that looking at historical returns, I could swear to it, or I'd have a high possibility. I wouldn't think that one could just, assume forever 6, 7, 8% returns from the U.S. stock market is going to continue. So I may not be that articulate in being able to express that in a way that convinces anyone, but there were a couple of articles out there, one from the Financial Times, blind faith in high equity return cult will lead to disaster. I love this cult. So the first quote is, the collective opinions, policies, and investment decisions based on the high equity return cult will lead to social, economic, and political disaster. The statistical construct of eternally compounded 6% plus returns has allowed people to believe this Disney movie. So anyways, I think it's good to hear, but I think CTAs who would never approach the markets in this way without a systematic approach, entries and exits, a back test with a big sample size of trades. We need to be on the front line on this and sort of say, we don't really buy into it. I don't know if there's any CTAs who have a permanent S&P position other than a few who market that as 50% equities, 50% managed futures on the side. But do they really believe that this should be a part of the managed futures portfolio? I doubt it. We play footsie with this idea because we don't want to make people mad. We just want to say, hey, allocate to me, please. I know you're mostly equities. I know you actually believe this stuff. I don't want to be controversial and radical, but I don't think we really do believe it.
Yeah, I think something that I've certainly been, trying to get through in many of the conversations and other stuff that I do is and maybe something that I didn't appreciate early on in my career. It's really the power of diversification. And just this morning, actually, there was someone, and I forget who it was on Twitter, that was quoting Buffett regarding diversification, because apparently he feels that diversification is not necessarily what you want, and there was some discussion about it, and I think someone came up with a quote from Buffett that diversification is kind of the it creates some kind of safety of ignorance, and that's probably true. I think that that might be fair, and there's nothing wrong with that. I would rather have a diversified investor who may not be because most investors probably don't spend very much time on their portfolio, so they truly need to be diversified in that sense. But of course, Buffett is someone that a lot of people look up to, and but he seems to be very concentrated in the way he does things. Even though I'm sure people forget that he's probably the owner of, I don't know, hundreds of companies, so he does have some diversification in his portfolio, but it's all within equities for the most part, I imagine. So, but anyways, diversification to me, I think, is incredibly important, and I don't think that a lot of people fully understand it. And it goes also to this point when we just look at our own industry, Jerry, and trend following. Again, something that I've mentioned before on the podcast is that I think people underestimate the value of diversification inside a trend following portfolio. They believe that if we just do trend following, we can just do it on equities, or we can just do it on fixed income or whatever market, and we'll be fine. But the reality is, certainly when I look at the attribution of performance on different sectors, different markets, using our own approach, we can have many years of a market not making money, and even sectors can go for a few years without making any money. So the power of diversification, I think, is underestimated. And I really like the fact that Ray Dalio has been out and really talking about this. And from some of the things that I've seen that he did, he boils it down very simply, very nicely, actually, where he goes on to say, if I can find 15 uncorrelated return streams, then I can really reduce or I can increase my return for the same level of risk by 500%. I mean, that's significant. And he talks about how he can reduce the risk of loss of a negative year down to around 11% compared to 40% if he just picked one of these assets to invest in. So, I think that, as you say, one shouldn't expect the S&P just to continue forever. And people really need to get there. Now that we've had 10 years or 11 years, however long it is, of this amazing bull run, people have had every single opportunity to make sure that their portfolio is in shape for what is to come. So there is no excuse, in my opinion. But there may not be so much time left before you need it. But that's a personal opinion. I'm not trying to make a forecast as to when things will go bad. But I think, I believe in market cycles. So I don't think even though this business cycle seems to be, going on forever and to eternity, and central banks are doing everything they can to make that happen, because one thing they can't afford is higher interest rates. But I do think that market history will teach us that things go back in their normal rhythm at some point. So I don't know, this is going off on a tangent here a bit.
Yeah, and I think I agree with, obviously, spent a career being obsessed with diversification. And CTAs have great diversification and shorts, which is so important. But it's difficult to get currencies, commodities, and interest rates into a portfolio unless you have a systematic approach, taking small losses, following price trends, and all the things that we use to create these systems and their characteristics. We have a big edge, and having all these different types of markets that we have access to safely, putting a commodity in, buy and hold. Once again, you're just looking at historical returns, which can fluctuate and can be a good market to include, then all of a sudden it'll be a bad market to include. But for trend followers, it's always good to have these markets in there. They all make money, and they're, basically, it's difficult to do that if you're fundamental. And then for the fundamental worldview, and we talked about this with Wayne a few weeks ago,
Sure.
It makes perfect sense to have a small portfolio because all the trades are not the same, like trend following. They have different expectations. You have your fundamental viewpoint. Your idea number 1 is your best and 10 is your worst, and you fully believe this. So why do 11 and 12? They're even worse than 10. And I don't know if that holds true if they ever go back and analyze their performance of what they thought was number 1 through number 10. But no, it's just a different worldview that we're not subject to.
Yeah, and I think, of course, you trade individual stocks from a trend following perspective. We don't, but I think there's so much. There's a lot of value in doing so for investors. I was just looking through some news flow this week, and this is not real news, but let's just look at it still. So far this year, equities are up strong, right, in general, both in the US and in Europe. And then I was looking at, the stock 600, this is in Europe, by the way. So looking at the stock 600 bank index, it's down 25% so far this year. And within that, of course, you have a bank that a lot of people talk about as an individual case, which is Deutsche Bank. It's down 97% or 93% or whatever the number is since it's high. And so, yeah, there are plenty of opportunities. And why would you approach even a sector like equities from a long-only perspective? So you and I talk about this from time to time offline, and this thing about, investors would be better off if they were trend following equities as well, even though I truly believe that from an overall portfolio point of view, you need to be fully diversified. But even if you're just doing it for your equity part of your portfolio as a long short approach, over time, I think you'll do better than a long only approach. Even though, of course, right now people are, people are picking the last 10 years or so. That's kind of the time frame that a lot of people are looking at. And I'm not necessarily saying they're cherry picking, but they are always quoting back to say, yeah, but look at how great equities have done in the last 10 years. But it's just not the way things are, generally speaking. When you expand that, horizon, you end up with this, 7% annual return-ish strategy that still provides, the 50% plus drawdowns from time to time. And often when you are in that 50% drawdown, people often reduce their equity portfolio, so they never actually experience the long-term 7% return.
That's right. It's a systematic approach. The S&P 500 is a rules-based approach that's almost impossible to follow. And you really do have to venture into a faith-based investing, religious experience. And as the worse things get, the better they get, because you can now jump in and buy at lower prices. It's silly. And just think about it. What's more risky than one sector, long only, in some sort of approach that just rotates amongst, big stocks and smaller stocks, and there's nothing riskier than that. So they deserve some sort of return in between the 50, 60% drawdowns. So I don't envy them, but it does make sense. And eliminating or severely reducing those drawdowns with a trend approach is huge. And I think people would accept a smaller return with more safety if they just knew better.
Yeah. It's a little bit like, and I know there's a lot of stuff going on in the media right now when it comes to aviation, and I don't want to go in that, right? But most of us would not go into an airplane flying for hours if we knew that there was just one system for each vital part of the plane, right? We would always want to have multiple systems in place should something happen. And I think there is some analogy that can be drawn on that when it comes to investing. Why would you put all of your eggs in one basket, so to speak? It might work. Of course, you can get there safely, but should something go bad, you need something else. Anyways.
And if the one system continues to perform so well, much better than everything else, and the culture continues to think that if you pay for anything more than 10 basis points, you're getting ripped off, and just continues to encourage this sort of, which I'd consider to be extreme behavior. One market, long only, all the time, never get out, follow the index, then it will only be in hindsight will people sober up and say, what were we thinking? How did we get sucked into that? CTAs were, they were telling us this, but the performance wasn't great.
Yeah.
So it's a bad situation.
It is, and it's kind of poignant that you mentioned that in a week where I saw that Morningstar was out saying that actually now, within a few billions, I think something like 5 or 6 billion, passive funds or assets managed by passive funds are now as big as active managed funds, and that's been a development that's been going on now for 10 or 12 years, where every single year actively managed equity funds was what I saw being quoted, had lost AUM, and passives have gained, but now they're the same size, something like 4.3 trillion or some whatever the number is. And so in one sense, I think the financial system, whether it be authorities, central banks, et cetera, and players have succeeded. They've basically changed our behavior of investing. all along, where equities have just had this 300% rally. So it's been the perfect time for them to promote this approach. But since I do expect that the 300% over 10 year won't continue, like you mentioned as well, what are all these passively invested funds? How are they going to react when the proverbial stuff hits the fan? You know, it may cause a lot more disruption than any of us can really imagine, because a lot of these investors have never experienced a crisis, let alone a depression. I mean, a lot of it. Let's go back to Ray Dalio. I mean, there is a reason, I think, that he is drawing a very clear, what do you say? He believes that what's happening right now is very similar to what happened back in the 1930s. And a lot of people, I mean, Neil Howie, who's been on for different, Real Vision and other places, talking about his book that he wrote 20 years ago that describes what's called the fourth turning. And the fourth turning is, every once about 100 years, you see these major shifts. And we're right. We're right there now. But according to him, and I thought, I think it's really interesting to listen to, even though we wouldn't use it as a trading indicator. But it's an indicator of perhaps what is to come for the markets that we do trade. And I think it strengthens one's comfort level to know that these strategies have been through many of these very disruptive periods and have come out of them every single time. And you can't say that about all investment strategies, but trend following, because it's adaptive, does have that ability. So a lot of interesting stuff going on right now. What else?
Well, I'd just like to comment on all of that.
Yeah, sure.
Yeah, I certainly will continue to look at the passive and active as not passive and active, but systematic and discretionary. I think even a systematic approach, as unsophisticated or bad as the S&P 500, is still better than discretion. So I think we win. We win again. I'm claiming this as our victory. Stocks have done well. You're concentrated in the best market. The bigger stocks have done better. It's just hitting on all cylinders, and it's going to continue forever. Well, maybe I'll disagree with that, but I definitely think that it's great to see that a systematic approach usually is going to be more of a discretionary approach, which is the typical stock manager approach. But and then I think another thing that we're quick to get criticized for, and there's a lot of articles written about crowded trades and crowding strategies, but somehow they never say, the most crowded strategy is passive indexes. Oh, no, right. I'm not going to hear that. No. Yeah. But like you say, there will be a lot of postmortems after the next big crash, which, I will pay no attention to until the trends change, and will embrace the stock trend that we've seen over the years because it was an uptrend. And so I do not care. I think CTAs do themselves a disservice by talking bad about the stock market, in a sense, if they're long the stock market. I mean, we're long with no emotion. And so I have no trouble making money from a stock rally, but you got to have a trailing stop. You got to have a stop loss. You got to have some shorts on. And I recommend some currencies and commodities as well.
Absolutely. So that's obviously a theme that we will continue to come back to, I'm sure. What else caught your attention or the attention of your followers this week, Jerry?
Well, it's the same theme. We had a couple of good articles on this same idea about really understanding the historical stock returns, especially recently, and what we should expect in the future. A few weeks ago, I tweeted an interview, excerpts of an interview from a professor, Aswath Damodaran, and this week another interview, and I tweeted a lot of this, and he says, the trouble with using the U.S. experience as the basis for saying that you should always own stocks for the long run is that you've got a survivor market, the most successful market of the 20th century.
Yeah.
And I think what he's saying is, yeah, there will be, even in a sort of a random strategy or a strategy that you really can't rely upon past performance or history, just go find, there'll be one that performed the best, and go find it and embrace it and throw all your belief systems away except for that. I think that's what we're saying is we're not sure that, I'm pretty sure you're going to get those drawdowns, but I'm not sure you're going to sit back and get this consistent return. It's going to beat all others, especially given the economies and dysfunction of the world's economies with interest rates and spending. I think I read a lot of articles from stock people who are negative on this market, yet would be happy to do battle with me to counter what we've been talking about this morning, is that we can just totally rely upon historical stock returns to continue.
Yeah, I mean, I think that, you bring up a number of good points. I mean, firstly, I would say, it's so true that we ended up picking kind of the S&P as the benchmark above all benchmarks, right? And it has just been relentless in its march north, and so that's obviously doesn't mean that all equity indices have been successful, and if we picked another benchmark, trend followers and CTAs might or will look a lot better, and who knows what the future will show when we look at this 10 years from now. And the other thing you mentioned is true as well. I mean, I listen to a lot of other podcasts where people are more fundamentally driven, forecasting, and have their macro themes, and they're great people to listen to. I find it very interesting to hear what they think is going to happen. And you're right, there's certainly a lot of people out there who are concerned and think things can get really ugly. But then one of the things I came across this week was that Professor Schiller, who became, I guess, well known back in around 1999 for publishing a book that basically said, things don't look so well and there's going to be an equity crash coming, and he was right. But apparently he's working on a new book at the moment to do with, and I forget the title of it, but it's to do with the narrative of investing. And I think that's really interesting, because I think narrative is something that plays a dominant role in how people invest, while on our side, of course, we don't pay any attention to it. We couldn't care less, and we don't have any stories to tell, which is, of course, why we never get and never should really be invited on CNBC and Bloomberg, because there's nothing to say about what we're doing per se, other than we can share the philosophy and we can try and educate people as to why it's important to have an approach like us. But specific stories as to why we're short corn or why we're long the S&P, we just don't have anything on the shelf to share. So but narrative in the investment world plays a big role, and so it'll be interesting to see what that book has to say about that particular issue when it comes to making investment decisions.
So the professor goes on and he says these strategies, these long-only strategies, rely on the idea that variables such as share price, valuations, or corporate profit margins will always return to a long-term average. Yet we know that sometimes things do go badly wrong or change radically, and that as a result, sometimes markets never revert. We extrapolate from what was an unusual period in an unusual we extrapolate from what was an unusual market in an unusual period, the most mean reverting stable market of all time. 2008 was the dividing line where I think there was a structural break in the global markets. I am less and less trusting of mean reversion on a daily basis. I mean, CTAs are shouting that from the mountaintop. Do not trust mean reversion. Do not extrapolate from from the best scenario possible. I mean, these are all kind of things you'd expect adults to say to children. Of course, doesn't matter if it worked. Doesn't matter what the results were. It was irresponsible, risky behavior, and that's what we're sort of saying. Get your portfolio as diversified as possible. Have some shorts on. Have a systematic approach based upon price, trends. Take small losses, and be bold with your profits. And it doesn't matter what the recent performance was.
Yeah, I mean, it's just one of those biases that are so difficult to deal with if you don't have a set of rules that you, apply yourself to, because these biases will be, tempting you to focus on all the things that you shouldn't, that you just mentioned there. And so, I mean, I think it was last time or the week before we talked about LTCM and those kind of situations. But of course, they had done, based on their research, these inefficiencies and these mean reverting type strategies worked until they didn't, and it all blew up in a big fashion. So it's certainly dangerous, but it just doesn't feel so nice to be doing what we do, to be buying the highs and selling the lows. It just, doesn't feel so great, does it? But it works, as we know. It just doesn't work in a smooth line, which we might. We might talk a little bit about noise and volatility later on, but let's continue if there are other themes in your thread of tweets this week.
Well, I'll just end with an article from the Institutional Investor written by a firm, CFM. I think it's a European trend-following large manager. I don't know if this is true. I mean, they wrote it. I suppose it is true, but I liked it nonetheless. Trend following tends to crash up as opposed to equities and fixed income, which tend to crash down, making it an excellent diversifier. It's a positively skewed strategy. The days of low amplitude tend to be negative, but those of high amplitude tend to be positive. Not only that, I would say that, as we said earlier, building up, taking small losses, but then on the other hand, allowing these open trades to get bigger and bigger and bigger, hopefully, and the trends to keep going. I think most of the time, if we're going to have a drawdown, historically, it's tended to be when we had big profits. So hopefully that's something that people appreciate. Okay, you were up 30, now you're up 20. You're up 20. So let's recognize that benefit of taking small losses and letting your profits run.
Yeah, no, I mean, I think it's a great way of explaining it, and I think it's true when you look at performance records of trend followers over time. I mean, there is these periods where you just have to be in it. Although I will say this is interesting. I heard it just this morning when I was out walking the dog. I was listening to a podcast, and it's this thing about that even people like, and I go back to Warren Buffett just to use him as an example. On this podcast, they were saying that if you took out the 5 best investments that Buffett have made in all of his career, his returns would just be average. And I think that's quite interesting to think about, right? So it's not that he's consistently better than everybody else, but he's got these 5 big outlier returns. And I think trend following, is it's kind of the same. We don't know where the next outlier is going to be. And if you took, say, the 5 or 10 best monthly returns out of our track record, like if you did the same with the S&P and so on and so forth, returns would look very different. And so it really nothing. I mean, this is going off a tangent here again, but I mean, it just goes back to that. Our core belief is that you need to have these strategies as an essential core holding. Don't try and time it. Don't be too clever. We don't know. But I think that CFM is absolutely true. Is absolutely right when they say that we tend to melt up. So we do go on these, 3, 4, 5 months return spurts where you just need to be there to get the benefit of it. But conversely, that typically goes the other way around when it comes to equities. You see these, like we saw during the financial crisis, you have 3 or 4 months where everybody's just running for the exit.
Yeah, that's right.
There's a tweet just coming through my screen right now from Ray Dalio where he says, almost nothing can stop you from succeeding if you have A, flexibility, and 2, self-accountability. I think that could be describing what trend followers are doing. We're certainly flexible and we're accountable every single day on a mark-to-market basis, unlike other strategies like private equity.
Which ironically, I think clients enjoy.
Yeah, they love
knowing
it,
what
of
the
course.
private equity is doing.
Yeah, absolutely.
Yep.
So funny. So we've got a question or two this week as well, which we will of course come to. I wonder whether, and I know, I mean, we talked about it just for a few seconds before we pressed record this morning, and there was this article that we were sent regarding noise and volatility, and actually one of our listeners wanted us to maybe talk a little bit about these two terms, because I think a lot of people, probably including ourselves, if we're honest about it, maybe not everybody knows. Well, we know volatility because that's what everybody talks about, and it's you're being used in every, in a lot of different ways nowadays in financial, in portfolio management and in investment decisions, et cetera, and of course the way we, size positions and so on and so forth. But then there's this other term, noise, and so I'm not so sure, and we were talking about it. We're not so sure necessarily that a lot of people know what the difference is, and we were not sure exactly what the difference is either. And this article does say initially that there is no universal definition of noise, yet noise probably is important, and it probably isn't exactly the same as volatility. And according to this article, there has been an increased level of noise in the last decade or so, and that increased level of noise could be, and I'm stressing could be because I don't think it's conclusive, but could be part of the explanation as to why returns for trend followers have been under pressure as an industry. I'm not saying all trend followers, I'm just saying as an industry. So I don't know if you have any thoughts about this at all, Jerry. We may have very little to say about it. We may have a lot to say about it, but it probably is important for people investing in this strategy, either as an investor, doing their due diligence and understanding the strategy they want to invest in, but also people who want to become trend followers themselves. Think about these concepts, volatility and noise, and maybe think about them as two different concepts.
Yeah, it reminds me of last week when I made the statement that there was a couple of things I don't understand. I know alpha was one.
A negative alpha.
The other, yeah. And then where do I'm so not interested in why we make money, why trend following works. Do we get it from the hedgers? Where is the source of our profit? We were taking it from someone. We must be taking it from someone.
We're stealing it effectively.
Yeah, from hedgers, I think, or somebody, I'm not sure. But then 3 is this noise thing. I don't, we both kind of looked at the article. We don't know what noise means. Article helped us not at all. And we both sort of said we dislike kind of cliches and words and that people use, and then it doesn't enlighten anyone. So anyways, I think if you look at maybe some of the back testing, and you'll see in the late 90s, the shorter term trend following that we were doing, it wasn't very good anymore. It stopped kind of working. So maybe this noise thing is choppiness, and we extend our look back period to hold on to trades longer and accept more volatility and bigger drawdowns because we have to be profitable. I mean, the first step in building a system is it profitable? If it's profitable, keep going. You can refine it a little bit, maybe make it a little shorter term or whatever. But if right out of the gate, if the system is a loser, you can't build much around that. Let's diversify more. No, it doesn't matter. It's a losing system. So if too many trend followers, it's crowded, you get chopped around, whipsawed, you go, as soon as you get out at the 50-day low, it goes right back to the highs again. Okay, is that noise, choppiness? I don't know what it is, but thankfully it doesn't, you can sort of figure out that you just need to extend your holding period, which may be unacceptable for a lot of people. It's too volatile now. It's too choppy now. The drawdowns are too large. The Sharp is not high enough now. I get it. But I think this is the reality we face. And I'm not sure if it's noise or what it is. And if it is noise, what am I going to do with that? And what knowledge, how's it going to make me better? I just ignore it and just figure out a more better look back period.
Yeah, and I think that's probably I think that is the way to look at it. But since I recognize certainly on our side that over time trend followers, or at least in our case and in your case, we have probably become a bit more long term in recent years, and so it definitely is true that if, as the article suggests, that this noise, which I think of it as kind of non-directional volatility of some sort, something we can't really use for anything. It's just there. That maybe it has gone up as they claim, and maybe that we don't think about necessarily as noise, but it has certainly. In our case, recalibrated our trend models to become longer term at time, and probably over time, longer term in general. So maybe that's what we reflect, just as changing our look back periods to overcome this. But as you say, the flip side of that is that our returns may seem more volatile. Even though, as the article does try and make a point, is that just because something is more noisy doesn't mean that it's more choppy, doesn't mean that it's more risky. And I think that is an important point, because we often talk about volatility isn't the same as risk. I mean, you can have a long-term capital management track record that didn't look very risky at all, but then suddenly you lost all of your money, pretty much. So the hidden risk was very big. And then you can have something like trend following, where there probably isn't that much hidden risk, because it looks risky all the time to people who may not understand necessarily what it's doing inside of it. And for us, we would say, well, we don't actually think it's that risky, because it's adaptive and it's diversified and it's long and short and all of those good things. So I think there's a couple of interesting points in it, but I wholeheartedly agree with you when you say that sometimes people invent these terms that are just not very helpful. And I have to choose my words carefully, because some of the people that I really admire and respect in this industry and come to the podcast and share their knowledge, they may be people who, in fact, in their own way of talking about markets and their strategy, use terms that I don't necessarily agree with, and I think it complicates matters more. And so I have to be careful on this. But I think trend following is generally a simple concept, and I think one of the things that we have not done well as an industry is to keep it simple. We want to make it sound more sophisticated, because maybe the investors have become more sophisticated. But if we think about it, a lot of and there are really smart people sitting, on the investment committees in many of these institutions that have become the bigger and larger share of the investor base in this industry. But we also have to recognize that there is an equal need for individual investors to have these strategies in their portfolio. And we need to be very careful not to speak above their head. I mean, if you speak to the professor, only the professor understands. But if you speak to the ordinary investor, then the ordinary investor and the professor will understand. So I admire those people who can actually keep things simple, yet get really important points across.
Yeah, that's good. I really enjoyed. It's no hidden. There's less hidden risk because it always looks risky. I love that. That's exactly right. But there's not a lot of people who agree. I don't think that there's a tremendous number who agree. I don't think there's a lot of CTAs who, by their actions, show that they agree that taking small losses and the win percentage is evidence that of our risk versus the standard deviation. So I think that if you are up 30% for the year and then you have a bad period and you're up 15% for the year because of open trade equity give back, I think those are losses. Those are losses to be avoided. That is a fat tail on the downside. I mean, I don't agree with that. But I think that, in fact, if we increased our win percentage from 40% to 50%, and we had fewer losses, and the losses were smaller, instead of 50 basis points, we lost 40 basis points, this would be almost imperceptible to other people, to clients. Oh my gosh, but if you have a big open trade, a hugely profitable period, and you give back open trade equity, which the only reason you have the big profitable period is because you gave back open equity over the last 12 to 24 months, and you didn't get out of those great trades too quickly. Oh no, that's redefined as loss, really risky, fat tail on the left side, on and on. So we need to make sure that we stick up for ourselves, and what we really truly believe is in highlight these facts that this is sort of the way we look at things, and we don't really agree about volatility. It can be, but most of the time, volatility for us is just fluctuation of mega profits.
Yeah, very true. Very true. Now, Sam sent in a question. I think it's the only question we have this week. So thanks for doing that, Sam. And to all of you out there who may have a question but forgot to send it in, then do send it to info@toptradersunplugged.com just info@toptradersunplugged.com because we love answering your questions every week. Now, Sam has a question which I think is, I'm sure there are other people that might think about the same issue. He says, you all frequently talk about the importance of multiple exits / timeframes within an overall strategy. I think this is a key component, but in most of my readings on constructing a portfolio, the vast majority of the content says equal weight the timeframes. Can you all discuss your definition / approaches to equal weighting as a broad topic? As an example, if I have 1 year and 6 month lookbacks, to me, equal weighting means allocating half as much to the 6 month as you do to the 1 year, because you have roughly twice as many opportunities. This means it would be 67% in the 1 year look back period and 33% in the 6 month. Because we expect all trades to have the same equal, I don't know what he means. There's a shortening here. I'm not know what that is. This is equal weighting. Expected volatility, it could be that what he's trying to say is the equal weighting to me when you factor in time frame volatility, position sizing, and expectancy. 50-50 would be overweight the faster / shorter time frame. I'm sure you have some thoughts about this, Jerry. I do as well. So how do you think about equal weight?
Well, I don't agree with what he said. I think weighting, probably the way I would try to describe it, it's got so many people out there who are smarter than me who can describe it better. But I think we'd just be risking the same amount in each trade. So if I'm going to risk 25 basis points on system 1, the 6-month look back, I'll risk 25 basis points on system 2 with a 12-month look back. Now, I think system 1 and 2 are going to make about the same amount of money. I can definitely come up with different parameters that have those same characteristics. One holds on longer than the other one. And I think what I remember from my back test is they make about the same amount of money. System 1 is shorter term. It gets out quicker. It's got to get back in. That's the problem. We have a mega trend. System 1 does 2 or 3 trades. System 2 does 1. And so they, pros and cons, they make about the same amount of money. So you can risk about the same amount per trade and give them equal weighting. I think that's. I read about that all the time too. It depends on who you read, I guess. If you read systematic trend followers, then I think that's what they say.
I mean, I think it's a great question, right? Because in some ways it shows that, and by the way, Sam, that, whatever we say doesn't mean necessarily that's the way you have to do it, right? We're just giving our opinion. But I agree with Jerry. Equal weighting for us means we take the same amount of risk for each of the sub models or for each of the time frames. That's just how we do it. But I think it shows that sometimes when you think about something, you can overthink it. Because I actually don't think that, there is a need to try and you make things that complicated. It goes back to what I said earlier. Trend following is generally quite a simple strategy, and we need to keep it simple. We need to be sophisticated about how we apply it and implement it. And I will admit that when I look at how we do trend following, and I wrote a little, I think I wrote some, maybe there was a quote out this week on Twitter where I said, we don't do trend following like we did in the 70s, 80s, and 90s the way we do today. I mean, we have obviously evolved. I think portfolio construction and things like that, we've become better at it. But I think we have to be incredibly careful about not overcomplicating matters. And in my view here, Sam, just keep it simple. If you have 5 different, time frames you want to trade, then give them an equal weight. Because who knows which one? I mean, this is the point. Who knows which ones will be most profitable going forward? We don't, so we need to treat them equal.
And we want them to give us diversification on the trades. So we have different exits and different entries for the trade. Yeah. But I think, you're totally correct. Don't really listen to us or listen to me, especially. But I do think that if you have, like my problem is that I trade, different entries and exits, but they're all very similar. And because it's just a space, in the look back periods where it starts to get a lot worse or it starts to drop off. And so I have multiple exits, but the correlation in a big uptrend is going to be really high. And it's just on the exit that it's going to impact my profit for that particular trade. And I think if you trade a 12-month look back and a 9-month look back, I feel pretty confident that you should weight them equally. But if you trade a 12-month look back and a 7-day system, the average holding period is 7 days and the other holding period is a year. Yeah, I'm unqualified to comment on that. I don't really know. It's beyond. I don't know how to trade short term, so I'm stuck.
But I was just going to say, sorry to interrupt here, but I was just going to say, you mentioned something that I do think is important, and that is sometimes I think people will look and say, yeah, but they're very correlated, et cetera, et cetera. Yeah, but correlation doesn't necessarily tell you anything about profitability. I mean, you can have 2 trend following managers, and we've done the analysis very recently, where you had managers that were, 0.6, 0.7 correlated to us. But our returns were so different, where you think it can't be 2 trend followers we're looking at. So I agree with Jerry. I mean, keep it simple, and even if it looks correlated over time, there might be benefits from return disbursement anyways between these different time frames in your case.
That's right. And when the markets are rallying, you want a lot of correlation. You don't want to be,
Sure.
you want everything to stay in there and don't get out too quickly. But when you finally do get out, your P&L on the different systems will be different, and enough to where you say, "Oh, I'm glad I didn't force myself just to guess or choose one exit." I think heating oil, crude, and unleaded are highly correlated, and I think recently they're 90% correlated. Well, I only got long one of those three in one of my systems. I'm very happy about that. And so there is some micro positivity on a daily basis. Your heart rate will be lower. Your anxiety level will be less if you trade a lot of different markets and if you trade a lot of different entries and exits.
Absolutely. Let me run through the usual performance where we stand right now for the month of May. So, and then if you have any final thoughts, Jerry, we can talk about that. But so these numbers, of course, as usual, they are as of Thursday evening. And I suspect yesterday, Friday, was not a great day for most trend followers. So we're probably down a little bit further than this for the industry is at least. The BTOP 50 as of Thursday was down 1.16%, up 3.69 for the month. For the year. As SocGen CTA index down 1.30 for the month, up 3.32 for the year. SocGen Trend Index down 1.45 for the month, up 5.66 for the year. And the SocGen Short-Term Traders Index down 49 basis points for the month, down 2.57 for the year. And finally, the British Alternatives Index is down about 0.25% as of Thursday, up 3.92 for the year so far. And of course, as mentioned, send us your questions as you normally do to info@toptradersunplugged.com. Jerry, any final thoughts on this? On these topics we've talked about, or anything else you want to bring up before we wind down and get ready for the rest of our weekend? I know it's still early where you are.
I did remember what I forgot earlier.
Good.
That you were talking about fat tails, and I think that the world is full of these fat tails and non-normal distribution. And I think that's what we've been trying to say on this podcast is be careful. It's a dangerous world out there, even with stop losses and trailing stops and lots of diversification. Use moderate leverage, follow your systems, and when you get knocked out and it goes back to the highs, you got to get back in. I mean, I think that's the most important thing. That's the problem with what we do is we got to get right back in, and it's hard to do.
It really is. And that is obviously what we want to help you with by passing on some of our experiences, the good and the bad, and not just on this podcast, of course, every week, but also for those of you who want to sit down with us for 2 days straight on October 26th, October 27 in New York. We want to help create some breakthroughs for you in your trading, in your business. We think we have a lot of tools in our toolbox that would be useful. So send us an email if you want to join us and put live event in the subject line. And for those of you who'd already send us an email, we will come back very soon with the final details. And we really look forward to meeting you. But as I said prior, this will be for a very small group, 12 people. And we already have more people who have raised their hands. But you shouldn't be discouraged, because sometimes when the final dates and all of those things, logistics happens, then maybe one or two people might not be able to make it in the end. So when we'll go to the quote unquote wait list, and hopefully one of you will be able to join us there. So anyways, enough about this. If you like what you heard today, as usual, we certainly always would love if you would share this episode with a like-minded friend. Just one is really all we ask for, because it has such a big positive impact on the number of people who discover the show. And of course, a rating and review wouldn't hurt either, because that's what iTunes love to see. So if you have a couple of minutes, please help us out on that. From Jerry and me, thank you ever so much for being part of our little podcast this week. And thanks for spending an hour of your time. And we look forward to being back with you on next week's edition of The Systematic Investor. I'm sure we'll be joined by Moritz next week. And in the meantime, have a wonderful and productive and profitable week ahead.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.